There's a well-known phrase in financial markets, sell in May and go away. It reflects a widely held belief that markets tend to underperform during the summer months. This idea is often referred to as the summer doldrums, a period where returns are weaker and price action becomes less directional. But as always with seasonality, the real question is, does this actually hold up in the data? And if it does, are there markets that behave differently? So today we're going to test two things. First, whether the summer doldrums exist in equity markets. And secondly, whether there are any assets that have historically behaved differently during this period. Starting with the S&P 500 here, we can test the core claim. Across the last 25 years, the period from May the 1st through to the 31st of October has often shown a weaker performance compared to the November to April window. This pattern has been widely documented and discussed in financial media, but it's important to be precise. This does not mean markets always fall in the summer. Rather, markets tend to be lower on average, trends can be less consistent, and volatility can feel more uneven. So you can see here, S&P 500 across the last 25 years has an average return of 1.80%. But there's a couple of things to be aware of. If you look at the last 15 years, you can see that the average return has actually been higher, 5.23%. And if you look in the last 10 years, you can see it's been a 90% winning trade percentage and an average return of 6.94% during the summer months. So you can see that it is quite a nuanced picture regarding the summer doldrums. However, if we wanted to look at this and compare it to the October to April window, you can see that the average returns tend to be much higher. And if you look over the last 10 years and the last 15 years, you can see the returns tend to be higher in this October the 31st through to the end of April window. Now let's look at the NASDAQ during the summer doldrums. The pattern still appears here, but with higher variability. So you can see over the last 25 years, the average return has been higher with the NASDAQ, 4.79%. But again, right, it's not a universal pattern that shows definite weakness during the summer months. And you can see if we just go down again to the last 15 years, the average return has been nearly double digits in the last 15 years. And in the last 10 years, it has been over 10.70% and 90% winning trade percentage. Let's look at European equities, like the DAX. In the DAX, you can see a slightly different picture. From May the 1st through to the 31st of October, the last 25 years, the average return has been negative 1.50%. And if we look in the last 15 years, just positive above the 0.50% mark, and in the last 10 years has been closer to 2% with a 1.86% average return. So we've seen that same kind of theme throughout all these summer doldrum periods, that the more recent years have tended to be stronger. So the summer doldrums, as we can see, they're not a collapse in equity markets. They're more a shift in return profile and consistency. Now, why does this happen? Financial media often points to several explanations. Lower trading volume during summer months, reduced institutional participation. There can be fewer major macro catalysts during summer holiday periods, and there's periods of reduced liquidity. And it's these factors that can contribute to slower trends, choppier markets, and just weaker average returns. Now here comes the second part of the question. Are there markets that behave differently? Because if the summer doldrums exist to a certain extent in equities, traders will often look elsewhere. Now, gold is sometimes regarded as a defensive asset, But again, the data shows mixed performance during this period. You can see from May the 1st through to the 31st of October, we have an average return of 3.90%. Energy with WTI crude, again, oil can show seasonal strength linked to demand cycles sometimes, but again, it's not consistently across all the years. You can see over the last 17 years, there's actually a negative 1.93% in this window. Now, there's another idea that often comes up during this period, which is that if the broader market slows down during the summer months, are there sort of specific stocks that tend to behave differently? And often you'll hear sort of companies cited like beverage companies like Coca-Cola and PepsiCo that benefit from summer demand as consumers look to quench their thirst. Similarly, there's defensive consumer names such as McDonald's or Procter Gamble that just have steady demand throughout the year. And in some cases, people look like travel or energy are discussed, reflecting seasonal demand patterns. So what about some of these summer stocks? Do they actually outperform during the summer doldrums, or is this just a narrative? And this is where the data becomes essential, because while these ideas can be widely discussed, they don't always translate into consistent and repeatable performance patterns. Some years they align with a narrative and other years they don't. So let's look at the Coca-Cola company. So you see Coca-Cola, big summer stock from the 1st of May through to the 31st of October. You can see that you've got an average return of 2.07% over the last 25 years. If we look over the last 10 years, you can see it's 3.20%, and the last 15 years, 2.41%. Interestingly, if we went from April the 1st through to the 31st of October, you can see that return does pick up somewhat. And in the last 25 years, the average return will actually be 4.03% if we started on April the 1st as sort of summer demand picks up. Looking at Pepsi, again, we see a similar pattern, that there is a positive average return over the last 25 years, 3.78%. But again, you can see that it's not every year that Pepsi tends to perform this well. And the more recent data has been better, 4.65% average return over the last 15 years. McDonald's, again, you get consistent demand regardless of the macro picture, and sometimes a defensive rotational beneficiary. You can see that average return from McDonald's is just under 5%, 4.84% from the 1st of May through to the 31st of October over the last 25 years, potentially sort of tailing off a little bit in the last sort of 10 years, 4.59%, 15 years, average return of 4.05%. Procter Gamble company, another company that tends to benefit from consistent demand, and a 5.70% average return from the 1st of May to the 31st of October. And there does seem to be a stronger period at the end of June through to the 31st of October. You can see there 6.88% return, and the standard deviation 7.11%, so slightly less volatile than some of the other patterns we've been looking at. So you can see Procter & Gamble does have some pretty strong years, although if we look in the more recent past, last 10 years, it's a 5.55% average return. So looking at Ryanair Holdings, in other words, another company that can potentially benefit from peak summer demand due to travel and leisure, but again, a very mixed pattern. Average return 2.99%, but quite volatile pattern, 21.09% standard deviation. So you've got years of great growth and then years of significant drops. And if you look at the volatility of the pattern, highly volatile. You've got maximum drops of 35, 30, 42%, 20%, 34%. So extremely volatile pattern, and really not very attractive for the investor who's looking for a sort of stable, consistent return. Looking at Booking Holdings, again, can benefit from peak travel and leisure demand, but again, average return 2.35% in this window, And over the last 10 years, you can see it's 3.91% with an outperformance in 2024. But again, quite a high standard deviation, again, showing a volatile pattern with some significant ebbs and flows. Certainly a volatile pattern to be looking at. Chevron is sometimes cited as a company that can benefit from the summer driving season as fuel demand increases, but again, a mixed seasonal picture. Average return of 1.31%, pretty choppy. And if we look in the last sort of 15 years, 10 years, 15 years, average return 1.23%. For 10 years, 15 years, average return just positive 0.12%. So really quite a mixed picture. So, the key conclusion is that there's no single asset, right, that consistently escapes the summer doldrums every year. It's a more nuanced picture. What we tend to see is that equities will tend to have a weaker average return during this period. Other markets can show different behavior, not necessarily better behavior, and variability does increase across the board. So the idea of escaping the summer is not straightforward. So how should this be used? Well, during the summer period, trend following can become less reliable, range-based strategies may become more relevant, and risk management becomes more important. Seasonality here is about adjustment rather than prediction. So the summer doldrums, they're real, but not in the way they're often described. It's not about markets falling, it's about lower returns, less consistency, changing conditions. And while other markets may behave differently, there's no simple seasonal escape. Seasonality does not remove uncertainty, but it helps you understand where and when it tends to increase.